Hello out there, DGI investors. Happy Sunday to you. It is Colby the DGI Crab coming back with undervalued stocks going into the week of October the 5th. That's right, it is time to make a game plan for the upcoming week. And I am back after taking a little bit of time off this week as I'm continuing to adjust to the demands of a new career. But I wanted to definitely make sure that I touch base with you all here today because we are going into the fourth quarter of the year. All the best teams in the NFL and in college football, typically the great ones, finish strong in the fourth quarter, and that's what we need to do here this year as dividend growth stock investors. If you had any goals for the year that you may not be pacing for, don't beat yourself up. But this is a time to reevaluate those things. Maybe if you are off pace for some of your goals for the year, you could look and see if you were maybe a little bit unrealistic in the goals that you set for yourself, or did life just throw some curveballs at you that threw you off track a little bit. That's why I personally like to set investment goals one quarter at a time, because life can definitely be really, really tricky, and you could usually make a little bit better of a plan 3 months out than 12 months plus out. But the nice thing about the stocks that we focus on here on this channel is that they are all blue chip stocks with long track records of increasing those dividends. I'm not a professional financial advisor, so you should do your own due diligence before you invest anything. I'm just simply sharing my strategy with you as a do-it-yourself dividend growth stock enthusiast. This is my personal strategy, where generally what I'm trying to do here is get automatic diversification by putting half of my new money at least into ETFs. So then I don't really have to worry about the diversification of my single stock portfolio, because I've got a wide exposure to the growth stocks if half of that portfolio is just on the ETF side in set it and forget it mode. And I'm basically just looking at the 10-year average dividend yield compared to the current day yield. And when I'm looking to acquire that sweet, sweet passive income, I'm looking to get it at a discount. So I am going to, as we do each and every week, we're going to hop into the spreadsheet and take a look at where those values lie. So, channel focuses on 60 high-value dividend growth stocks, but I do split them into 4 smaller subsets or tiers that are based on the age and timeline of the investor. That's the most important metric that you should all keep in consideration. So this first group of stocks here I refer to as the Tier 1 group of stocks. These are lower yielding stocks, generally in the 1 to 2% range, but they have a very, very high growth rate on that dividend year over year, well above 10% as a group. That's what we're looking for here with this group of stocks. 30 and younger, lots of time to be able to acquire these, hold on to them for years at a time, and let those 10% plus dividend increases snowball over the decades. United Health, Nike, Nordson, these have been the 3 undervalued stocks in this category for quite a while now. Nordson has recovered really nicely. We were buying Nordson as low as $180 a share at one point earlier this year. It has rebounded up past $230 a share. So it is right there at the precipice for me of being in that buy zone. Generally speaking, I want that current day yield to be at least 30% higher than the 4-year average yield. So when I'm acquiring a share of Nordson, I'm getting $3.28 of forward passive dividend income a year, whether I'm acquiring that 328 at 230 a share, 220 a share, or 180 a share. That's the timing of the market that we're working on here. I would much rather acquire this income at $200 a share than $230. So for right now, Nordson, we could be sunsetting on our buying of Nordson if it continues to go up too much more. But United Health and Nike are the dogs of this category, and I'm going to just keep on pressing forward with them until they perhaps cut their dividend, which I don't think any of these stocks are in danger of that anytime soon. For Tier 2, the age 31 to 41-year-old investor, the starting yield in this group of stocks is a bit higher, we're more in that 2 to 3.5% range typically with this group. And what we're looking for with this age range is a dividend growth rate in the high single digits. Not quite as rapid as the tier 1 category, but a bit higher starting yield. That's our trade-off here as we move up through the tiers. Target, American States Water, McCormick, three excellent choices of undervalued stocks in this particular category. Target, unbelievably to me, as it just continues to slide further and further, yielding comfortably above 5%, so much higher than any of the stocks in this particular tier. There's only one other stock in this tier right now that's even yielding above 3%, which is Texas Instruments, which is reasonably priced, but not remarkably inexpensive either. Target, though, has just absolutely taken a pounding. The dividend growth rate on Target is probably not going to be in the high single digits anytime soon, I wouldn't think. But I do think that they're going to continue their dividend growth streak. The dividend should be safe. You're getting paid a lot to wait, though. So 5% plus starting yield on Target, it's definitely one that I'm going to continue to add, even though times aren't looking great for them right now, and that's why their current day price is so low. That's kind of what we're waiting for as value-based investors. Tier 3, age 42 to 53-year-old investors. These stocks, starting yield gets a little bit higher. We're in more of that 3 to 4.5% range. Dividend growth, we're hoping for anywhere from 4% on the low end to maybe 7% on the high end. Little dull, very steady, very stable stuff. Hormel and Pepsi are the only two viable stocks in this particular category. Pepsi is one of my personal top 10 favorite dividend growth stocks of all time. More than happy to continue adding to that position with a starting yield at 4% or more. Absolutely, I am. Hormel really has just been a rough last couple of years for Hormel. This was a stock that used to be trading in the $40 range, and then it just slid down into the 30s and then started sliding down into the 20s. And for a dividend king with a high payout ratio at 76%, but not a completely unmanageable one, a dividend king with more than 50 consecutive years of increasing that dividend, this just seems to be a stock that's getting punished a little bit too much right now. Hormel has so many different products that are the number one selling category in its particular brand that I do think that they are eventually going to recover. And kind of like Target, the starting yield on this one is so high right now that even if it takes a year or two for the dividend increases to get back to normal, the trade-off is you're acquiring a lot more income right now while you wait. Income that you could utilize to reinvest dividends, continue buying the more shares of it with that drip while the price remains pretty low. Again, some of these might not recover when they get down really low, but the reason that I picked each and every one of these 60 is that the track record is so long on them. All of these stocks have been through very difficult times before where there were a lot of naysayers in the market saying that you should run for the hills. And really, when it comes to this sort of thing, I'm primarily concerned with increasing my dividend income. Share price is going to swing around month to month, day to day, year to year. But what is that dividend income doing? And with all of these, it steadily continues to go up, regardless of what the share price is doing or what the forces in the market are saying what we ought to do. For tier 4, the 54 and older investors, this is where we're not as concerned with growth anymore. We're just trying to acquire high starting yield, not as many decades left in the market for those large dividend increases of tier 1 and so on. We've got to get that income now. 5% or better is usually what we're looking at here. I would still like to see us be able to get, decent 2 to 4% dividend increases out of the group just to keep up with normal years of inflation so we could still get some payment increases even when we're not reinvesting our dividends anymore. Again, nothing in this group is undervalued, although we have had a little bit of shakeups in terms of which stock is on the top of the list. Right now, Essex Properties would appear to be the most undervalued stock in this particular group, but at just an 11% discount. I'm not racing to my app to purchase shares of Essex Property if I'm in this particular category. Real quick, I always like to just take a quick swing by the top 10 tab. These are my personal top 10 favorite dividend growth stocks, which I will purchase if I am simply put, in the mood for it. I don't pay quite as close of attention to the metrics on some of these. For example, I don't wait for Microsoft to have a dividend yield that's 20% higher than the 4-year average, because if I did that, I would have never bought Microsoft ever at any point. So for some of these, I will wait and try to find it maybe just when their yield is a little bit above the 4-year. So like for example, right now, Procter and Gamble, which is in that tier 3 category, at just 14% off, to me seems like a pretty reasonably good deal on a super blue chip stock. So if I'm kind of looking through this here, if I'm a tier 1 investor, I'm definitely going to prioritize the 3 in my own category first. And then I would definitely consider the top 10 favorite stocks next beyond that. So maybe some Pepsi, some Procter and Gamble, and honestly right now Waste Management, which is currently right at the 4-year average yield, might not be a bad time to just add some Waste Management. The share price is a little bit down right now, and while it's not cheap, it's kind of another one of those like a Microsoft or a Visa. Um, it's just not going to be cheap all that often. So if you want to build a position in it, grab it when it's at fair value as opposed to grabbing it when it is cheap. So for me, I like to put half the money into ETFs. And just as a refresher to all of you out there, this is generally the strategy that I look at with that ETF money. If I'm in tier 1, I want to have about 25% of my money at least just going into the S&P 500. When you're trying to beat the market, this is what you're trying to beat. So I just like to hedge against that a little bit, make 25% of that portfolio part of the market, and then you can sort of fill in the gaps with everything else. For those younger investors, I like having a small cap value ETF in there, and then something like VIG. Lower starting yield, but should very, very consistently grow the dividend over time. And I've still got VYM as my number one preferred choice for non-US stock investing. VYMI all the way across the board. It's a 5% allocation for me. I like the higher starting yield. I think that there's enough of a chance of growth potential on the share price, the yield, and also the fact that it's got roughly 1,500 stocks in it at any given time across all these non-US markets. It's super diversified, keeps me from having to worry about what's going on in other economies across the country. Just keeping track of the US economy is enough trouble for me. Tier 2, same 4, slightly different allocation. Tier 3, shifting into things like SCHD, VYM, DHS, 42 to 53. That's about the time to make that transition. And then for tier 4, you guys, especially because there's not anything in that smaller subset of tier 4 stocks that looks to be super cheap right now. For tier 4, if I were 54 and older, I just have everything going into the income ETF category that I've got here. I do have separate videos regarding the breakdown of why I chose this set of 10 ETFs to be the income generating beast combination for the 54 and older investors. But you can go check that out in the ETF playlist. But this is about the allocation here for the week, you guys. Plenty of things to buy, plenty of stuff that is undervalued going into the final quarter, which is great news because the stock market overall in the year has been doing pretty well. It's up once again, which means that there's not a wild amount of values that are left to be had out there, but we've definitely had some good rebound stories. Things like Hershey, Nordson to an extent, Genuine Parts Company in tier 3, So let me know what you all are buying, and I will see you next week. Finish strong.